And here we come to volume and time. Force index links volume with price change. To me, this is the best way of tracing volume. Well, the formula is here. Let me show you the chart. Basically, the force index multiplies price change by volume. And there are two ways in which I follow it. Here is the subtrend, the same, this Google that we're chewing on. And the trend is up. And every once in a while, force index drops below 0. So the tide is up. Force index identifies a wave that hits against the tide and basically says, this is a good buying area. If you use a very long-term, if you use a long-term 13-bar moving average, it helps catch major trend reversals. Let me show you what I mean maybe in the current markets. Here is this chart of the S&P. And at the bottom is a 13-bar force index. It trades in an envelope, and every once in a while, it gets out of the envelope, and then it comes back in. Here, force index very slightly popped out of the channel, and on the next bar, it came back in. Here, came out of the channel, and on the next bar popped back in. It doesn't catch every bottom and every top, but when it does give you a signal, we better pay attention. You see, it shows when volume swings heavy outside of the extreme and comes back into the channel. Let's apply this to some stocks or commodities. Yeah, gold. Okay, so this is the weekly chart of gold. Here it came into, here was a buy signal, and here was another buy signal, and here was a sell signal. Strangely enough, this indicator works very well on the weekly charts and nothing on the dailies. So in gold, basically, there is no signals since it told us to sell gold in March. It wasn't a bad signal at all, but nothing much is happening.
GM.
Okay, GM. Take a look. Sell signal, not shabby. Another sell, and another sell. A buy signal, not shabby. Here, I think, here was a bad signal, very rare occasion. And here the signal came back again, and off to the races. And nothing much since then. Potentially this was a signal. I mean, it doesn't happen at every top and at every bottom, but what this spike of weekly force index does, it shows some kind of extreme event, extreme volume that went too low or too high and choked up. Crowds do not maintain extreme for a very long time. You know, there is a riot, and eventually the riot runs down. And you go to the place where everything was a riot a week ago, and it looks absolutely peaceful. Emotional extremes are not sustainable by people or by crowds. As soon as force index starts returning into the envelope, it shows basically that the riot has broken. These to me are among the best long-term signals in technical analysis. They don't happen very often, but when you see them, better act. Let me pull up a few stocks. CMG, $660?
Was that Mexican food? I mean, really?
Well, that's not a bad sell signal, is it? And it's currently on a buy signal from here. 660. There's Chipotle across the avenue from where I live, and I've never been inside. I better go there.
And it's just been climbing. You know, taking out the time frames a little bit, it's just been unbelievable.
Well, this is the weekly chart. Yeah. In any case, let's let me take a look at something I'm interested in. Tesla, it's actually approaching the lower channel line, curiously enough. Google, approaching lower channel line. Amazon, midline. Yeah, so no signals, no signals there. And just for another view of force index, we go now to the daily chart. The trend is up. When force index goes below 0, that's generally the good time to buy. Time in the markets. I observe that markets move at the same time in different time frames. They move on the weekly charts and daily charts. They move on the hourly charts and 10-minute charts. And they can be moving in different directions. They can be rising on one and falling on another. So when we analyze markets, we should really pay attention to more than one time frame. All of those time frames are connected to each other by approximately a factor of 5. A monthly chart, where a bar represents 1 month, 4.5, approximately 5 weeks. A weekly bar has 5 days. A daily bar has 5 to 6 hours in the trading days, etc., etc., etc. So we can slice these things by a factor of 5. We have by now reviewed the indicators, including force index, which is based on volume, and time in the markets. So we're approaching our trading systems. But at this point, I'd like to take a bit of a pause and suggest we take a test. 4 questions. What is the trend? Of course, at the right edge of the screen, that's where it matters. Mark undervalued zones, mark fairly valued zones. And what do you recommend doing at the right edge of the screen? 1, what is the trend? 2, mark undervalued zones. 3, mark fairly valued zones. Your trading stance at the right edge. So I think that the trend is up here. The undervalued zones are obviously below both moving averages. There is one in July and another one in early August. The market is fairly valued inside the value zone. And at the right edge of the screen, I would be looking to buy. If I cannot be in front of the screen during the day, I might place an order probably down the middle of the value zone. Let's do puzzle number 2. Mark zones of mania and depression. So, how about this? Mania, 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 right? And I think there was just one depressive episode here. Puzzle 3. Identify the pattern at the right edge. So this is the pattern. We have top A of prices and top A of MACD histogram. So maximum power of bulls. B, breaking the back of the bull. And at the right edge, C, prices do everything right. They run outside of the channel. There is a small kangaroo tail, and the MACD histogram ticks down a bit. And if we now go forward, this is what happened next. It was a bearish divergence, and a tremendous slide followed.